Here's the truth. You've probably avoided investing because you think it's complicated. You imagine you need to pick winning stocks, watch Bloomberg all day, or hire an expensive advisor. But what if I told you there's a way to build serious wealth that's so simple, it takes maybe 2 hours to set up, and then you basically forget about it? That's index fund investing. And today, I'm showing you the exact 5 mistakes that are keeping beginners from starting, so you don't repeat them. Let's get real about what an index fund actually is. It's not complicated. It's literally a bucket of stocks bundled together. Instead of you picking Apple, Microsoft, and Amazon individually, an index fund does it for you automatically. The most popular one? The S&P 500, which is just featured of America's biggest companies. When you invest in an S&P 500 index fund, you own tiny pieces of all 500. That's diversification built in. Studies show that 90% of professional investors, people with Ivy League degrees, working at hedge funds, fail to beat index funds over a 15-year period. You're literally doing better by doing less. That's mistake number 1 people make. They think they need to be a genius stock picker. You don't. Mistake number 2. Thinking you need thousands of dollars to start. You don't. You can open an account with most brokers, Vanguard, Fidelity, Charles Schwab, with literally any amount. Some platforms let you start with $1. Now, realistically, you should probably start with at least $100 or $500, so transaction fees don't eat into your gains. But the barrier isn't what you think it is. Mistake number 3. Not starting early enough because you're waiting for the perfect time to invest. The market will always have uncertainty. There's always a reason to wait. Recession fears, inflation, election cycles. But here's what the data shows. If you invested $500 a month starting today, even with market crashes included, in 20 years, you'd have roughly $280,000, assuming a 10% average annual return. If you wait 5 years, you're missing $30,000 in gains. Time in the market beats timing the market every single time. Mistake number 4, investing a lump sum and then panicking when the market drops 20%. Market's correct. It happens. A 20% drop is normal and actually happened in 2. But here's the thing. If you panic sold, you locked in those losses. If you didn't touch it and kept investing, you made money on the dip because you were buying stocks at lower prices. That's called dollar cost averaging, and it's powerful. Mistake number 5, the big one, not automating your investing. You set up an account, feel motivated, make one deposit, and then life happens. You never invest again. Solution? Set it and forget it. Automate a transfer from your checking account to your investment account every single month. Make it automatic on payday if possible. This removes emotion and ensures you actually stay consistent. So here's your action plan, and this is what makes this actually doable. Step 1. This week, pick a broker. Vanguard, Fidelity, and Charles Schwab are the big 3. All 3 are solid. Open an account. It takes maybe 15 minutes online. Step 2. Fund that account. Start with whatever you can afford monthly. Even $50 matters. If you can do $200 or $500, that's even better. But don't let perfect be the enemy of good. Step 3. Buy a simple index fund. For beginners, I recommend a total stock market index fund or an S&P 500 index fund. The symbols are VTI or VOO for Vanguard, FSKX for Fidelity. These are the workhorses. You buy one fund, You own hundreds of companies. Step 4. Set up automatic monthly investments. Most brokers have this feature. Set it and never think about it again. Now, I want to be clear. This is educational content about personal finance and investing for beginners, not financial advice. Always do your own research and talk to a qualified financial advisor before making big decisions. But here's what I know. The biggest wealth builder for regular people isn't picking winning stocks. It's starting early, staying consistent, and letting compound interest do the heavy lifting. Albert Einstein supposedly called compound interest the eighth wonder of the world. A $500 monthly investment earning 10% average annual returns becomes $280,000 in 20 years. That's not luck. That's math. That's passive income building in the background while you're living your life. The hardest part of investing isn't understanding index funds. It's actually starting. It's doing the thing when there's 1,000 reasons to wait or overthink it. You now have zero excuses. You know what index funds are, you know the 5 mistakes to avoid, and you know your exact first 3 steps. The only question left is, are you actually going to do it this week? If you found this helpful, please like this video and subscribe for more personal finance tips and strategies on how to save money